A&J Capital. Today's video will be about covered calls. If you're new to option, covered calls are a good beginner strategy because they're seen as low risk and they're simple. Basically put, a covered call, you sell out of the money calls on stock you already own. And remember, options are leveraged products. One option contract is representing 100 shares of stock. Let's say you had 200 shares of E&J Capital stock. Cover calls are good when you're already in profit and you're not in love with the stock anymore. If you're really bullish on the stock and the stock's at 50 now and you think in 2 months it's going to 100, then don't do a covered call. The reason I say don't do a covered call is because with covered calls, your upside is limited. It caps your profits. You don't want to get capped. Hold your shares and let it go to the moon. So let's say you want to do a strategy. Since you have 200 shares, you could sell 2 calls. Since we're talking about selling options, option sellers have an obligation to fulfill. If the buyer of the contract exercises those contracts, you will have an obligation to sell those shares to the buyer. Like let's say you didn't have these 200 shares in your portfolio and you just sold 2 calls, that would be naked, and that's seen as unlimited risk. That stock can go crazy high. And if the person on the other side of your trade exercises those options, you're going to have to buy at whatever price it's at. Hundreds of shares at whatever price they exercise at. So, be careful. Since you already have those 200 shares, you're covered. You don't have to buy anything extra. The buyer of the contract is in the money, then the shares you already own are the shares that's going to go to that person. So if you have to be okay with giving away your shares. But if you get to the point where you give away shares, you made a profit. Let's say the price of those together were $4. So the max profit is $400 that you can collect, the premium you can collect. Let's say right now E&J Capital stock is at 50 bucks. What you would do is you would sell an further out of the money call, so a higher strike price. So that could be $60, it could be $55 strike. If the stock goes up, you'll still own the 200 shares until it hits 55. And then once it hits 55, somebody will exercise it and they will take your shares off you. You still collect the $5. So you collect the $5 from 50 to 55, and you collect the premium for selling. But like I said, it's capped at 55. So the stock can go even further. It can go to $80. You're already out of the trade. You know, you don't still have the 200 shares, so you wouldn't make the extra $30 per share. So you missed out on that. So that's why I said if you're really bullish on the stock, don't do covered calls. A few scenarios. The stock could either go up, stay flat, or go down. If the stock goes up, you collect the premium, but you give away your shares. If it stays flat, which is probably the best case scenario, stays flat, right? You collect premium, and you get to keep your shares, which means you could just do this whole process again for next week or next month or wherever. Or it can go down, which means you would collect the premium, but the shares will be less valuable. But since you collected the premium, you could see it as your cost base is going down because you collected an extra 400 bucks and you still own the shares. So the only risk really is the risk of what happens with the shares. But you knew that ahead of time when you own the shares in the first place. You know the stock can go down. So you want to find something that's relatively flat with a little upside potential. It tends to be flat. It doesn't jump too much. It had its drop, but I expect it to trade sideways like it usually does until something big happens again. Let's say you bought 500 shares of Coca-Cola, which means now you could sell 5 calls. So you want to go a little out of the money, but unfortunately the farther out of the money you go, the less you can actually collect. And it gets to the point where, like, is it even worth it? Let's say you sold 5, which means the max premium you can make is $250. So you would collect the premium, the $250 premium, and you would gain the profit from when the stock rise to where you sold the call at 45 and a half. 500 shares, sold 5 call options. Anyway, E&J Cap,